Well, good afternoon, everyone. I'm Joe Lopresti, the president of Arlington Wealth Management. Welcome to our Proactive Investment Management webinar. Appreciate you taking the time to join us today. I want to tell you a little bit about what we're going to discuss today. And we sent out invitations to the webinar describing the fact that it has the market hit an inflection point. History shows us that there are key times in the market. So let's say, for example, the year 2000 or the year 2007, where the market dynamics change and it's an inflection point in the market. And the question we posed, has a similar inflection point occurred in 2022? So we're going to talk a lot about that in terms of that. Certainly the market dynamics have changed this year relative to what we saw over the last few years or several years. So there's always the chance that we've seen a significant shift in the character of the market. Okay, so let's get started in discussing the topics today. Everyone's concerned about what's happening in the marketplace, what the Federal Reserve policy is causing in terms of asset prices. And I want to start off by showing you a chart that I think puts things into perspective. This is a 70+ year chart of the S&P 500. And the red segments on this chart designate the bear markets that we've seen during that period, being defined as a drop of 20% or more. You could see that we're currently in the 11th bear market in that last 72+ years. So when we look at the previous bear markets, I kind of see two different types of bear markets. One, they're kind of isolated, run-of-the-mill declines that occur, by themselves, but have pretty quick recoveries. Like this is one in 1987, for example. That was famously known as a crash there. In fact, today's the anniversary of that crash, October 19th, 1987. The Dow dropped more than 20% that day. But you could really see that it's a pretty isolated event. And prior to that, there was a strong bull market in place. After that, for many years, there was a strong bull market in place without any bear markets surrounding it, right? 2020, the COVID drop was one of those kind of isolated events as well. And maybe back here in the 1950s, there were one or two of those types of isolated events too. But then I see something that looks a bit different. Let's say something like this, which is a series of bear markets. And it's not an isolated event where you have one decline and a recovery followed by another decline and a recovery, or back here in the late 60s through the 70s, even into the early 80s, when there was a series of bear markets and recoveries. Now, the reason that this is so different is it takes a long time to recover from this type of bear market, right? So for example, if we look at the chart, we're separating out the bear markets, the red periods. The recoveries are the blue periods, right? Another decline and another recovery. Well, that right there took 13 years, right? So if we hit a major inflection point, which obviously we did in the year 2000, then writing out that period took really 13 years for a passive investor, somebody who is going to stay in the market through that entire period, to regain their previous high in their portfolio value. In the 1960s and 70s and early 80s, there was even a longer period where the market was either declining and investors were losing money, or they were recovering lost money, right? So when we look at this chart, there's really two different types of bear markets: the isolated example, or the example that is what we would call an inflection point. It's going to last a lot longer, The recoveries are going to take a lot longer, and that's much more psychologically difficult for investors to write out, not to mention economically difficult to write out. Okay. So I'm going to ask a question here. Is the current bear market that we're experiencing 2022, is it a run-of-the-mill type of bear market like 1987 or 2020 where we should have a quick recovery? Or is it a major inflection point like we saw, say, starting in the year 2000 or in the 1960s? Okay, so answers are in far and away. Everyone believes that it's a major inflection point. 85% of the respondents and only 15% believe it's a run-of-the-mill type of bear market. So the next question I would have, and this isn't going to be a poll, just for you to think about internally, is if you do believe it's a major inflection point, as many of you do, the next question is your investment strategy designed to handle an inflection point in the market like we saw here in the year 2000 or in the 1960s? That's something for you to think about after the webinar is over. There are two mainstream thoughts, line of thinking in the market. One is that you should ride out market downturns because it always bounces back. The second is that you should take action to try to prevent lost wealth during market downturns. When you look at this chart of the market and really study it, the result of writing out every market downturn may not be acceptable when it's applied to your goals and your circumstances and your objectives. Long-term history of the market shows there are lengthy periods when the market goes through advances, for sure, as you could see with the green segments on this chart. But there are also lengthy periods where it's either declining or recovering from a decline for many years, like this 13-year period from the year 2000 to 2013, before a passive investor started to accumulate new wealth again. And over the full 72-year period, more than half of the time, you're either losing money in bear markets and recovering the lost wealth, or recovering the lost wealth, I should say. So 54% of the time, you're going through a decline or recovering that decline. Only 46% of the time are you actually building new wealth for investors. And what makes it worse is when you get into these types of bear markets that are not isolated occurrences. They're major inflection points and generally last for 10 years or longer, where the market is not making progress. So that's the key question, and that's why we're holding this webinar today. Have we hit that inflection point? Many of you believe that we have. We think it's quite possible as well. But in our research, we really show that it boils down to two variables, right? Whether this is a run-of-the-mill bear market or that major inflection point. The first is what the market valuation is when the bear market starts. Okay. The second is the economy and whether we enter into a recession or not. The run-of-the-mill bear markets tend to occur without recessions and from low valuations in the market, or I should say not high valuations in the market. That helps them recover a lot faster and last much shorter. The major inflection points tend to occur when market valuations are extreme and we enter into a recession. So let's take a look at a couple of models that we've designed to help us identify these types of market conditions. The first is our market valuation model. Okay, so this requires a little bit of explanation. The blue line on the chart is the model itself. It records the valuation of the S&P 500. So when it's high, that means stock prices are high, they're overpriced. When it's low, it means values are good and stocks are underpriced. Well, when we entered into this bear market, and this is reflected as of the end of last year, December 31st, you could see that according to this valuation model, stock prices were very high, at their highest ever. So that opens up the potential that this bear market is the beginning of a major inflection point, more so than a run-of-the-mill type of bear market. Now, we're going to come back to this indicator a little bit later and show you a more updated version of it. Stock prices have dropped and valuations have come down a bit, but they're still extremely high. But the value of this type of indicator is that it's counterintuitive, right? In the sense that when the indicator's high, future returns tend to be very low. So the shaded area on the chart is what happened in the S&P 500 in the next 10 years, right? So in the year 2000, for example, the previous high prior to last year's high, if you bought the S&P 500 and you held it for 10 years, your return was actually negative, right? So high valuations, low returns. High valuation, the expectation is for low returns over the next 10 years. If we go back to the previous era's high valuation here in the 1960s, low forward 10-year returns. But when valuations are low, like they were through the 70s here, or even the 80s, the future 10-year returns are very high. When the market dropped through 2000 into 2009 and valuations were restored at reasonable levels, that then resulted in a high forward 10-year return in the S&P 500. Okay. So when we have high valuations previously, that was the start of a major inflection point. Now, this indicator itself is not going to determine when the inflection point starts. It's not going to determine when the cycle changes in the market, right? It's just going to tell you that stocks are priced high and there's a lot of air underneath them to potentially drop. But it's not going to be a good timing indicator to determine when the tide is turning in the market. So when we look at really the two variables that we found that determines whether it's a short run-of-the-mill bear market or something that could last many, many years, the first variable is in place, and that is at the start of this decline, stocks were priced extremely high. The second is the economy. And whether the economy enters into a recession or not is crucial, because all of our research shows that bear markets that are coupled with a recession are extremely much more longer and last longer, and they drop a lot deeper than bear markets that are not coupled with a recession. So this is one of our recession models that we use to help us determine whether we're going to be entering into a recession or not. And what we could see is the current picture does not look good for the economy. This is a leading economic indicator. It's a predictor of a recession. And over the last few months, it has moved into predicting that we will have a recession in the future, right? So if we look at the other types of inflection points in the year 2000, for example, we saw that the same type of indication, right? There's two lines on this chart. One is what we call a long leading index. The other is just the leading index. So the long leading leads the leading. And then the gray bars on the chart are when the recessions actually occurred. So if we look at the year 2000, there was that same type of warning as we're getting today, right? But prior to that, with the exception of a short recession in 1990, there were no recessions from 1982 all the way to 2000. And that's one of the reasons why you saw very little in the way of bear markets through this entire period. The only exception was that 1987 short bear market, which recovered very quickly, right? When we saw this recession and a recovery, and then the next recession in 2008, we saw this type of market where there were repeated bear markets, big declines and recoveries. And that's what we call a secular bear market, very long period of either declining or stagnant stock prices, right? And then since that time, once again, no recessions. There was the COVID drop, right? But that was a different type of recession, more government induced and not caused by natural cycles, monetary cycles, and other types that, you know, tend to cause these other recessions. But other than that very short recession during COVID, there have been no recessions. Well, that's once again why we saw a very long period here of no major bear markets, right? But here we are now. We obviously are in a bear market, and sorry for jumping around here. We are likely headed into recession. So this looks very similar to the setup in the year 2000, right? We had high valuations in the year 2000. We have high valuations going into this year. We had high valuations in the 1960s. Back in the 60s, we had a number of bear markets into the 60s, 70s, even into the early 80s. A number of recessions developed, right? So this setup looks very much like a major inflection point has occurred in the market. And that has widespread consequences on your investment portfolio. The game has changed. It's a much different environment today than we saw for that very long period, right, where stock prices were just rising since 2009. We didn't have any 20% drops at all, except for that 5-week period during COVID, when the market did drop more than 20%. But this is a different animal, right? It's a different type of character to the market. And that's why we wanted to bring that to your attention and hold this webinar to just, you know, make sure that you understand that this is a different environment than what we've experienced for a long time. Now, when we look at these long periods during the 1960s, 70s, during the 2000s, when stock prices were unable to make significant progress, for example, from 2000 to 2013, it took 13 years, right, for the S&P to regain its 2000-year high. But that's not looking at inflation adjustment of your wealth, your portfolio, right? So if we look at the 1960s, the last time we had a high inflationary environment, right, during the 70s in particular, inflation was very high. That prolongs the amount of time that it takes for you to recover your purchasing power, right? You may get back to what you were if the previous high in 10 or 12 or 15 years, but to then account for what you lost in purchasing power due to inflation, it could take much longer. So back here in the 1960s, when that high hit there in 1965, this is an inflation adjusted S&P 500 chart, right? It didn't take just 10 or 15 years. It took nearly 30 years. It wasn't until 1995 that investors really started to recover not only the wealth that they lost from the drop in the bear market in the 60s and 70s and early 80s, but the inflation impact on their wealth. So in today's environment, obviously, we're in a high inflationary environment. We haven't seen this type of inflation in 40 years. It was, since the 1980s, we haven't seen this type of inflation. If you look at this year, for example, I believe the S&P 500 is down something like 21 or 22% coming into today. Well, if inflation is also 8%, that really means you're down, close to 30% adjusted for inflation. So it's important to not just write out bear markets. Another way to think about the impact of a bear market is to consider the time it takes to recover, right? Not just from the way that we looked at it, but how much gain is it going to take in the market to recover? And, obviously these short declines and small declines, honestly, we try not to focus too much on them because they're not as damaging as the big declines, obviously. Number one, the decline tends to be much shorter in nature in terms of time. And two, the recovery is very quick. Those declines, 10, 15, even up to 20%, they could happen during corrections in these long bull markets, right? But once we start getting into the 30, 40, 50% type of declines, and we need 54, 67, 100% returns to recover, those are the ones that, in our view, you really should focus on avoiding and have an element in your strategy that could help you identify when these types of market conditions are developing, to be able to shift to preserving wealth during that type of market environment. When we had the bear market in, sorry, I'm going to jump back to that long chart of the S&P. When we had this bear market in 2000 and a recovery and another bear market in 2008, those were two 50% drops in the S&P 500. Both required 100% gain to get back to the previous high, right? And that's why it took so long to start building new wealth again. Whereas all of these short drops really are immaterial in the big picture, right? So still sometimes aren't fun to go through, and it does help to try to mitigate some of that volatility with your investment strategy. But the ones that to really focus on are these big drops that take a long time to recover. So having a economic model, a recession warning model is important. Having a market valuation model is important. But there's a third model that we use that really helps us to identify the change of the market cycle, right? Because those other two models from a timing perspective are not really going to be helpful. They're going to tell us that the conditions are there for an inflection point or a major bear market, but they're not going to tell us when the cycle's changing. And for that, we turn to our market model. So I'm going to start blending in a little bit of our approach to managing investments. We really aligned our investment management approach with the top concern of our clients, and that is wealth preservation. They're going to be okay. Their families are going to be okay, provided that they don't lose money during major market and economic downturns. Right? So our clients' top concern is preserving their wealth. So we built a quantitative model to help understand the potential risk levels, the market trends, the economic cycles, and the possible turning points. We take a much different approach than the vast majority of advisors that are generally going to keep you invested in the market most of the time and will advise you to ride out market downturns because the market always bounces back, right? And it may be true that the market always bounces back, but it's also true that there are periods that are decades or longer where the market doesn't bounce back. So is it going to bounce back in your, based on your time horizon, with your objectives and the things you want to do with your life? And even if it does bounce back, do you want to see a 50% drop in wealth while waiting for it to bounce back, which could take several years? So we believe there's times when it's appropriate to shift from accumulating wealth to preserving wealth. At times we seek to scale back risk. At other times we look to eliminate it, even in our most aggressive growth strategies. All of our investment strategies incorporate this overriding risk management philosophy. And a little bit later, I'll show you that, we're not always in hunker down mode. In fact, it's a minority of the time, only 15% of the time is our model telling us we need to be in wealth preservation mode. 85% of the time, we're focused on accumulating wealth. And we have strategies that can do that. And I'll show you, when we do get that next opportunity and the model shift back to telling us that we should focus on accumulating wealth, I'll show you how we do that. But it's also important to have this wealth preservation as part of a proactive investment approach. So we use the recession warning model that I showed you. We use our market valuation model, but we also have a market model. And the market model is designed to identify the prevailing market cycle, whether we're in a bull or bear market. The recession warning model is designed to alert us to a potential recession several months in advance. And the valuation model helps us understand what the very long-term potential in the market is. Should we expect high returns over the coming 10 or 12 years, or are returns likely to be very low? And the reason that's important is it requires a different type of investment strategy. When valuations were very low in 2009, riding this type of market trend is a lot different than when valuations were very high in 2000, riding this type of market trend. So, while our clients' top concern is wealth preservation, I want to be clear that they also desire to accumulate wealth, to enhance their lifestyle, provide for long-term needs, prepare for the unexpected, and pass wealth on to their heirs. When our market and recession warning models are positive, which is the vast majority of the time, our focus is on wealth accumulation to help them achieve their life goals. So let's take a look at some of our market model and the proprietary indicators and model that we designed. And we've built a pretty vast database over many years. It's our proprietary database. It's custom software. All of this was built in our effort to want to better understand market tendencies. We conducted more than 6,000 market tests and research studies over many years to develop our approach that we call PAS. PAS stands for Proactive Asset Allocation Strategies, and it incorporates all three of these models that I'm showing you: the market valuation, the recession, and the market model. And it helps us understand when there are times to shift focus from accumulation to preservation. Okay. I'm not going to get into a lot of the technical details of the model because that would take a lot more time than we have here today. But to give you a little flavor for what type of indicators we have and that we've developed, I'm going to show you a couple of them briefly. What's on the screen is called our cash comparison chart. And without getting into the details of how it's recorded, just focus on the major trends, right? So for example, when it's generally moving from the lower left to the upper right, that's when the risk is low to own stocks. When it's moving from the upper left to the lower right, that's when it doesn't pay to take the risk to own stocks. And you're better off holding cash. And that's why it's called a cash comparison chart. So if we look at these cycles, they're pretty evident on here, right? Bull markets and bear markets, bull market. And now we see a potential change, right? And that started, with a high late last year and then started to unfold with the change of direction earlier this year. What I really want to do, though, is focus in on these two periods. because if we look at the last 25 years or so, even longer, go all the way back to, the early 80s, the two times you really needed to be in wealth preservation mode were right here, right? Year 2000, year 2007. Anytime during here, yeah, there were a couple of scary times, but no major bear markets that took many years to recover. Prior to that, no major bear markets that took years to recover. But these two times right here, if you had a guide to help you understand that things were changing at those two times, that could have been key for your wealth. So if we look at those two times in more detail, we could see them right here, right? So you could see the general rise in the trend. This is going back to the mid 1990s, moving up. And here you could see the turn, right? If you just follow the outside of this chart, there's an obvious turn that takes place. And right through here, it confirms that there's a change in trend that was in, say September or so of the year 2000, right? And then the same thing or similar, not exact, but similar type of pattern set up in the year 2007 into the year 2008. So this cash comparison chart tells you that this is the time you should hold cash. It also gives you the turn higher, that this is the time to move from cash back into taking the risk in stocks, because you should expect a better return. You could see the turns at both of these bottoms. Well, if we go back to today, the question is, do we have another turn? And as of today, it looks like, yes, likely we do have another turn down. Now, there's no way to know by using this chart how long it's going to last and how far it's going to drop. But the point is that we have a change in the market. But we could go back to our market valuation model. We could go back to our recession model and understand that likely this should be a longer and deeper decline than a run-of-the-mill type of bear market. Another one of our indicators we call the long-term momentum indicator. Now, this one is much different and uses different types of calculations to determine what the momentum on a very long-term basis is in the market. And it's invaluable in helping us identify primary bear cycles. So I'd like you to note the change once again here in the year 2000 and in the years 2007. So what we're looking at is when the indicator is green, all the momentum calculations are positive. When the indicator's red, they're negative. And if there's a white shade, then there's some conflicting calculations, some positive, some negative. But if we look at when this change happens, it happens relatively early in a new bear market, right? It's never going to tell us where the top is because it's a momentum indicator. But all we want to know is when that momentum is changing. Now we can look at this year. We could see starting in January, it turned negative. And that was, very early in the decline here in this bear market. Now, if we look at every major drop, or really the two major ones, right? The two big ones that you needed to avoid in the last several decades, 2000 and 2007, you could see how this indicator turns negative early enough to give you the warning that conditions are changing. Right now, there are other times when it also turns negative, which is why we don't use any one indicator in isolation. All of these indicators that we've built, these two examples, the cash comparison chart and the long-term momentum, are two of the indicators we use, but they complement each other, right? When they're both turning negative, like in 2000 and 07, that gives us the heads up. So let's bring that long-term momentum indicator around to that same year, 2000 and 2008. And again, what we see is that the two times that it became important to preserve wealth, both the long-term momentum indicator and the cash comparison chart gave that same warning, right? And unfortunately, we have the same type of situation developing here in the year 2022. So that's why, that's why it's important, we believe, moving forward, that your investment strategy has to have an answer good enough to a bear market as it has to a bull market. There has to be a way for you to preserve your wealth, to avoid these big declines. We have no way of knowing how long this one's going to last or how deep it's going to go. Based on the recession models, that recession hasn't even started yet. So likely there's more to go to the downside. Based on the market valuation models, there's also likely more to go to the downside, right? This is a really good analysis of market corrections since 1965, and then separating them by the ones that are coupled with bear markets and the ones that are not. So the black diamonds on the chart are the drops, the corrections without a recession. You could see the average is about 15%, right? So decline of 15%. The red diamonds are the bear markets with a recession. The average there is 36%. What's more is the amount of time. Without a recession, a drop pretty much resolves itself within about 100 business days, 4 to 5 months. With a recession, it takes over 300 business days, or 3 times as long. And you could see plenty of these recessions, recession-related drops, I should say, that took even longer. So our proprietary indicators, we believe, give us an edge in understanding when significant bear cycles may be developing. When the indicators turn negative as a group, as they did this year, the probability increases that a major bear market has begun. Now, we call this our tornado warning system, right? These are the tornadoes, right? Now, we may get the warnings to go off during these, but the tornado doesn't develop. It's just kind of a passing storm. But when the tornado hits, we want to be protected, and our clients want to be protected. So we have a heavy focus on shifting to wealth preservation when the conditions are there for a tornado to hit. If it doesn't, generally speaking, the models will give us the all clear siren, and we know that it's safe to then get back into the market. But when we're in the middle of the storm like we are right now, there's no way of knowing, are we going to have that category 5 type of tornado to hit? So that's something that I want to encourage everyone to assess your investment strategy, and give it a good solid stress test. Say, if we have a major bear market here, what's going to happen? What is my portfolio going to look like? Is there an answer to that type of market condition that, with a higher degree of probability, we've entered into now, more so than we've had since, say, the year 2000? Here's an update of our market valuation model. So this is now bringing it up to date through June 30th, which is the latest data that we have for this type of indicator. And you can see we've come off of the high substantially, right? So stocks were priced very high on December 31st, as I showed you earlier. Today, stocks are still priced high, but not as high as they were then, because we had 2 quarters of decline in the first quarter and second quarter, When this is updated for the third quarter, we're surely to get yet a further decline in this indicator, but it takes a few months for the data to come out to update this chart. But nonetheless, we're not at a low valuation, right? Valuations are getting restored, but they haven't been completely restored, in the sense that we can now look at the market as a good long-term investment opportunity. You could see what that generally takes as we work through these other cycles. It doesn't happen in 6 or 9 months to begin with. This one took 9 years, right? This one took even longer and much deeper to go before we have the setup in place where we could really look at the S&P and say, now we could expect really good long-term returns. And during that time, you don't have to be as active. You don't have to be as tactical with your investment strategy. But during times like this, when things are unwinding, we've come off, the market's a better buy today, certainly, than it was at the beginning of the year, now that it's down 20-some%. But we're still expecting very low returns in the next 10 years in the S&P 500. This is a good time, I think, to shift to another poll. In this challenging economic, social, and political environment, we're finding a lot of people are unsure if their wealth management plans are on the right track or if they're getting adequate advice from their financial advisors. It's not uncommon. In the last few months, we've met with a number of investors who have that concern. So we're going to offer everybody on this webinar a complimentary second opinion on your wealth management plans. Our second opinion service is a consultative process. It starts with what we call a discovery meeting. During this open dialogue, we learn about you and where you are now, where you're aiming to go, what matters most to you. And then we'll look at your wealth management plans to determine if your plans are in alignment with your direction. So what you could expect if you decide to have a second opinion is you would experience a portion of our elite wealth management process for no cost. There are 3 potential outcomes for the work we would do for you during this time. First, we may find that you're in good shape in your investments as well as your other advanced wealth planning, and recommend that you stay the course. That does happen, and we're going to make that recommendation to you if you're in good hands and you're moving in the right direction. Second, we may find you have some gaps in your situation, but then we would take a look at if we're the right advisors to potentially help you. If we don't believe we are a good fit to provide you the solutions you need, we'll introduce you to the resources that could help address your needs better than they're currently being met. Finally, if we find that you have some gaps in your situation and believe we are a good fit to help provide you with solutions, then we'll discuss how we could potentially move forward in working together. Now, we can't work with everybody. We work with a select group of families, but we find when there's a real good fit with what a family needs and what we do, that we look to add a lot of value and make a big impact in those families' lives. But either way, you'd receive a personalized analysis of your current situation. So if you are interested in that, you could give a positive response there. And what you could expect is we will give you a call probably sometime later this week and just have an initial discussion to see if it's appropriate to move forward with setting a meeting and getting the discovery process underway. Well, as we talked about earlier, the majority of the time, our market models are positive, right? And we're focused on wealth accumulation. And we're talking about a lot of doom and gloom today because that's the scenario that we're in. But, let's talk a little bit about the next opportunity, because it's going to come. Whether it comes in the next few months or it takes much longer, it's hard to say at this point. But our models are there to help us determine when that point is. And I'd like to take you through a little bit of our process of how we would select investments when we do get that next opportunity. And one of the things that I think a lot of investors make a mistake on is that they expect things that were real good in the last bull market, once this bear market is over, they'll become good investments again. We find that's generally not the case. The previous bull market winners generally do not lead the next bull market. There's usually significant rotation of leadership in the market from one bull cycle to the next. So I'm going to show you a couple of tools that we've built to help us determine how we would select investments when we do get that next opportunity. And in fact, before I do that, I'm going to take a quick step back. I'm going to show you an investment map, right? So first, we have several different strategies that we'll use to manage a client's portfolio. We have 7 strategies that range from those that are designed to provide cash flow and income to support your lifestyle, all the way to high growth strategies to create new wealth over longer periods of time, and several in between. And one of the first things that we do, and in fact, this would be part of the second opinion service, we would provide you what we call an investment map, where we look at 3 objectives: lifestyle and liquidity, providing reliable cash flow and income to support your lifestyle and ensure financial independence. Then moving on to growth and longevity, asset growth to enhance your lifestyle, provide for long-term needs, and prepare for the unexpected. And then moving even further to legacy and aspirations, creating new wealth through investments in high growth strategies to help facilitate meaningful asset growth to either transfer wealth over generations or support any other aspirations that you have. And we always want to make sure that a family's investment strategies are balanced through these 3 objectives and are in alignment with what's important to them, right? And then there are strategies that can help produce the cash flow. Everyone's on a different situation there. Some families need more cash flow from their investments, others need less. We want to make sure you have adequate assets that are targeted to provide for that need, but not have too much of your assets providing for that need. Make sure that you have adequate assets providing for your growth and longevity and your high growth strategies for your use later in life or to pass on to future generations. So when we do get a buy signal with our model, all of these strategies will be put to work, and they all select investments in different ways. But our flagship strategy that we call PAS, Proactive Asset Allocation Strategy, is going to use our asset class ranking system. This system's designed to help us isolate the potential leading asset classes in any particular market cycle. Asset class leadership, as I mentioned earlier, it's going to vary from cycle to cycle based on many financial and economic variables. In specific cycles, growth stocks focusing on technology and other types of leading disruptive industries may lead. That's what was in place in the last bull market. In different cycles, value stocks and economically sensitive sectors are the leaders. So this system ranks hundreds of different asset classes, industry groups, foreign markets, commodities, and investment themes. And we use a proprietary formula that we designed to help identify leaders, asset classes that exhibit specific leadership characteristics. So in short, this helps us separate the stronger and weaker groups in the market so we could focus on the potential leaders. Now, based on all the research we've done, we have really good reason to believe that asset classes exhibiting leadership characteristics at the time of our market's buy signal, our model's buy signals, they're likely to lead the market forward in that particular cycle. So when we look at a select list of asset classes that have been leaders in various market cycles in recent years, themes like semiconductors, were represented frequently, home building, automobiles, online retail, biotechnology, solar energy, all have been kind of repeatedly showing up in our leadership when our model has given signals to buy during the previous bull market. So as we discussed a little bit earlier, that depending on market conditions, we may diversify in more asset classes or focus in fewer ones at other times. So what we really aim to do is invest in, say, 5 to 7 asset classes in most market cycles. We don't want to be over diversified, because that just leads to what we believe are, kind of lackluster results. We want to be focused in the potential leading asset classes. So we always go back to a buy signal date to show an example of this. And the last meaningful buy signal in our model, you could see here, came June 5th of 2020. And so that was, think about, we went through the COVID drop in 2020, and as the market was rebounding, our model gave its last major buy signal prior to the sell signal that we saw this year in the model. And this was the leadership board at that time. And you could see the ones highlighted in green: automobiles, online retail, semiconductors, organics was one of the thematic groups that was selected, retailing, and so forth. It's a top-down approach. So first, we want to make sure the market is in the proper position to take risk and expect a good outcome, right? Today, the market's not there, but the next time it is, we'll use our ranking system to help us determine which sectors, asset classes, industry groups, and so forth we should focus in to expect a good return. The next chart is going to show a handful of these asset classes that were selected, and you could see them here: automobiles, online retail, semiconductors, retail, and over the following 8 months or so, what type of progress they made during that time. The top one was the automobile sector. The bottom one was retail, but all made strong gains during that period of time. So we have strategies that will invest in ETFs, exchange traded funds, to give you exposure to these areas of the market. We have strategies that will invest in individual stocks that will take it to the next level, right? Where we rely on the asset class ranking to identify the leading asset classes. We then look at another way of ranking stocks in those asset classes to help us focus on the potential leading stocks in those groups. And that would be one of our higher growth strategies. So I'll open it up for any questions that anyone might have at this point. So one question's coming in: how can you help me preserve wealth? Well, I think we spent a fair amount of time in today's webinar answering that. Wealth preservation is the number one concern of our clients. They worked hard to build their wealth. They're going to be in good shape, provided they don't lose it in market and economic downturns. So our investment approach aligns with that number one concern. It incorporates the different models that we use to identify, declining markets. And again, our focus is, we believe strongly there are times to mitigate risk and focus on preserving wealth and shift it away from wealth accumulation. And there's going to be a time in the future when the focus should shift from preservation back to accumulation, when our proprietary models indicate that that's the right time. So there's another question coming in. What type of cash investments would you recommend at this time? Well, there are various types of cash investments that are similar. Money market funds are paying, yield in the 3% range for many of them. Treasury bills are also, I think, investments to consider for the short term. So I would focus in those areas if cash is the type of investment that you want. If you've gone to cash with your last sell signal, are you mainly invested in treasuries? How do you determine the duration? So cash is where we go to with a sell signal. That's the first step. The first step is we want to look to preserve wealth. That's the primary focus. As this bear market has developed and our economic models in particular move negative, we then set our sights for a longer decline. So we are holding sufficient cash, but in our managed portfolios, we've also moved into some investments that are, I would say one of two categories. One is uncorrelated to the stock and bond markets, where we're looking to make some progress that isn't relied on the market to make progress to achieve a positive result. The second category would be in our more aggressive strategies. We've invested in some funds that are designed to move in an inverse direction to the market, right? So as the market's declining, these would advance. Of course, it could go in the other direction too. When your model predicts a certain sector will excel, do you invest in funds or individual stocks? And the answer to that is we have really strategies that will do either. So we have strategies that will focus in funds, exchange traded funds. We have strategies that will invest in individual stocks as well. We don't utilize options at all in our strategies at this point. How about CDs? I think CDs are fine. The only problem there is you're locking into a specific term. And we would prefer cash investments that are liquid, because when the next opportunity comes, we want the ability to move from preservation back to focusing on accumulation. Because this is going to be, when that opportunity comes, this will be the best opportunity we've seen in probably 20 plus years. If I do a second opinion, what could I expect? Well, one of the things I could potentially show you here is an infograph that shows our wealth management exploratory process. Basically shows the steps that we would take you through during a second opinion of your wealth management plan. Yeah, this is our wealth management exploratory process. So it starts with a discovery meeting where we sit down with you and talk about where you are now, where you want to go, look at your wealth management plans to see if you're on track to move in the right direction. After that meeting, we'll develop your investment plan, and we'll put together a plan that will be our recommendations on how to optimize your assets to achieve the goals that you told us about during the discovery meeting. We'll present that plan to you during the second meeting, the investment plan meeting. And then from there, we move on to talking about our investment strategy and providing you details on our investment management approach. We did that, in pretty good fashion here today, but we'll take you in a little bit deeper during that time. And then we move on to whether there's a good basis for us to mutually decide if we should work together toward achieving your most important goals. So that's what you could expect during a second opinion service. There's a question about if there's a minimum to invest. And the answer to that is we don't have a minimum per se. What we really take the approach on is let's first see if there's a good fit in working together, if we're in good alignment with what you're looking for and what we could provide. And if that's the case, then we could find a way to work together in most cases. Okay, well, looks like most of the questions have come through at this point. Once again, thanks for taking the time to visit with us. And we'll be following up with you with recording as well as the handouts so you have them for your own use. Thanks, everybody. Have a good day.